So, you want to make your money work for you. Well, that is a wise and important goal. Many people hear about the stock market and see it as a way to build wealth. They are correct. However, there are two very different ways to approach it. These two paths are called investing and trading. Both involve buying and selling assets like stocks, but their methods, their mindsets, and their outcomes are worlds apart. It is very important to understand the difference before you put your hard-earned money at risk. One path is not always better than the other, but one will likely be much better for you. Choosing between investing and trading is a critical decision. It will shape how you spend your time and how you manage your emotions. It will also influence the level of risk you take on. Think of it like deciding between planting a forest or hunting for your food. One requires patience and a belief in long-term growth. The other requires speed, skill, and constant vigilance for immediate results. This essay will explain both paths in simple terms. We will look at what each one truly means, so you can make an informed choice that fits your life and your financial goals. The reason this topic matters so much today is because technology has made both paths accessible to everyone. With just a few taps on your phone, you can buy a piece of a company. This ease of access is a wonderful thing, but it also brings new dangers. Newcomers can easily confuse the quick thrill of trading with the steady discipline of investing. They might follow a trader's strategy when they should be thinking like an investor. This confusion can lead to costly mistakes. Understanding the fundamental principles from the very beginning is your best defense against losing money unnecessarily. Our goal here is not to declare a single winner in 5 minutes. Instead, the goal is to give you the clarity you need to decide which approach wins for you. By the end of this discussion, you will have a clear picture of what investing is and what trading is. You will understand their core differences in time commitment, risk, and potential rewards. This knowledge will empower you to take the first step on the path that aligns with your personal circumstances and your vision for your financial future. Let's begin by exploring the first of these two powerful methods. Investing is the act of buying a part of a business, not just a flickering stock price. A flickering stock ticker isn't the same thing. When you invest, you become a part owner of a real company. You buy shares with the intention of holding them for a long time, typically for many years or even decades. Calendar pages flipping, years passing. The core idea is to let your money grow alongside the business itself. An investor looks for strong, stable companies that have a history of good management, steady profits, a clear plan for future growth. The goal is not to profit from a price jump tomorrow, but to benefit from the company's success over a very long period. The time frame for an investor is long-term. Think in terms of years, not days. An investor might buy a stock today with the goal of funding their retirement in 20 years. They expect the market to have its ups and downs. There will be good years and bad years. But the investor has faith that, over the long run, the value of good businesses will rise. They are not worried by daily news or small price swings. Their strategy is built on patience and the power of compound growth, where the earnings from their investment start generating their own earnings over time. Let's use a simple example. Imagine you research a company that makes popular electric cars. You study its financial reports. You see that its sales are growing. It is making a profit. And it has innovative new models planned. You decide it is a solid business. So you buy its stock for $100 per share. An investor would then hold this stock through market fluctuations. If the price drops to $90 next month, they do not panic and sell. They hold on, believing in the company's long-term value. 5 or 10 years later, if the company has succeeded as they predicted, that share might be worth $500. The risks in investing are very real, but they are different from trading risks. The biggest risk is that the company you choose might fail or perform poorly over the long term. If the business declines, the value of your stock will decline with it. This is why investors often diversify. They buy shares in many different strong companies across various industries. This way, if one company does poorly, the success of the others can help balance out the loss. The reward is steady, often substantial growth that can build significant wealth over a lifetime with less daily stress. Trading is a much faster game. Its focus is not on the long-term health of a business, but on the short-term movements of its stock price. A trader buys and sells financial instruments, like stocks, much more frequently. Their goal is to capture profits from price volatility. A trader might buy a stock in the morning because they expect good news to push its price up, and then sell it in the afternoon for a small gain. They are not concerned with the company's 5-year plan or its dividend policy. They are only concerned with where the price is headed in the next few minutes, hours, or days. The time frame for a trader is very short. A day trader opens and closes all their positions within a single day. A swing trader might hold a position for a few days or weeks to profit from a predicted swing in the price. Traders rely heavily on technical analysis. This means they study price charts and use various indicators to identify patterns and predict future price movements. They are trying to time the market perfectly, buying just before a rise and selling just before a fall. This requires constant attention and quick decision-making. Here is a simple trading example. A trader notices on a chart that a certain tech stock has consistently bounced up every time its price has dropped to $45. They see the price is approaching $45 again. Based on this pattern, they place an order to buy the stock at $45.01. A few hours later, the price does indeed bounce up to $47. The trader immediately sells, making a quick profit of nearly $2 per share. They are not interested in holding it longer. They have made their profit from the short-term price move and are now looking for the next opportunity. The risks in trading are high and immediate. Because traders are trying to predict short-term movements, a sudden piece of news or an unexpected market shift can cause rapid losses. A trade that looks promising 1 minute can turn into a losing position the next. Many traders use leverage, which means borrowing money to make bigger bets. This can magnify profits, but it can also magnify losses dramatically. The potential reward is the ability to make money quickly, but the path is stressful and requires immense discipline to cut losses before they become catastrophic. It is a high-stakes activity. The most fundamental difference between investing and trading is time. Investing is a marathon. It is about patience, allowing your money to grow over many years, riding out the inevitable bumps. Your success is tied to the long-term performance of the businesses you own. Trading is a series of sprints. It is about speed timing, capturing small profits from market noise. Your success is tied to predicting short-term price direction. This difference in time horizon dictates everything else. This leads to different risk and reward. Investing generally involves lower risk over the long term. Your portfolio will fluctuate, but diversified good businesses tend to grow over decades. The reward is slow, steady wealth accumulation. Trading involves higher short-term risk. Any single trade can cause a significant loss, especially with leverage. The reward is potential quick profits, but also quick losses. High decision frequency means more chances to err. Effort differs greatly. An investor does homework up front. They research companies to find quality businesses. After that, effort is minimal. They check their portfolio a few times a year. A trader's work never stops during market hours. They watch screens, analyze charts, follow breaking news that moves prices. It's an active, demanding job needing focus and emotional control, not a passive, casual activity. Consider emotions and costs. Investing needs discipline to stay calm and avoid panic selling. Trading needs discipline to stick to a plan, take losses without hesitation, avoid greed and risky bets. Costs differ. Investors trade and frequently pay low commissions, benefit from long-term tax treatment. Traders trade constantly, rack up commissions and fees which erode profits. These practical differences are crucial when choosing a path. Now we arrive at the most important question: which path is right for you? There is no single correct answer for everyone. The The choice depends entirely on your personality, your resources, your goals. To find your answer, you must be honest with yourself. Ask yourself 3 simple questions. First, how much time can you truly commit? If you have a demanding job and a busy family life, the patient, low-maintenance approach of investing is likely a better fit. If you have several hours every day to dedicate to research and active market watching, then trading becomes a possibility. Second, what is your tolerance for risk and stress? Think about how you would feel if the value of your account dropped by 10% in one day. If that thought makes you feel sick with anxiety, you are likely better suited to be an investor. The slow and steady nature of long-term investing is designed to be less stressful. If you thrive under pressure, handle the emotional roller coaster of quick wins and losses, have the discipline to stomach risk, then the high-stakes environment of trading might appeal to you. Be realistic about your own emotional fortitude. Third, what are your financial goals? Are you trying to build a nest egg for retirement in 30 years? If so, investing is the proven path for long-term wealth creation. The power of compounding over decades is a force that trading cannot easily replicate. Are you instead looking to generate a secondary source of income right now and are willing to risk capital to do so? If you have money you can afford to lose, trading could provide that opportunity, though it is by no means a guarantee. Your goal will point you in the right direction. In the end, the choice is yours. For the vast majority of people, especially beginners, the principles of investing offer a more reliable and less stressful path to growing their money. It is a strategy built on a solid foundation of business ownership and time. Trading is a specialized skill, much like any other demanding profession. If you are drawn to it, start by learning everything you can and practice with a demo account before risking real money. Whichever you choose, commit to learning. Start small, be patient, never stop seeking knowledge. That is the most valuable investment you can ever make.